everyone. Thank you for joining us. I'm Krista Das, and you're watching Smart Investing Market Insights at TaipanFinancialNews.com. Several months ago, the only news on television or in the newspapers was about oil and rising gas prices. Then it was quiet for several months until just a few weeks ago. If you haven't noticed, gas prices at the pump have slowly been creeping up. In fact, according to GasBuddy.com, prices nationwide average around $2.61 a gallon. Last year at this time, gas prices were $2.47 a gallon. And just last month, we paid on average $2.36 a gallon. So what price will we be paying in the next few months? And what does this mean for oil? Today, I've invited market charting expert and creator of Wave Strength Options Weekly, Adam Lass, to share his views on the market and what we might expect for gas and oil prices. Adam, thank you for joining us.
Always my pleasure.
Let's get right to this. Do you think it's foreseeable that we'll be paying $3 a gallon for gas?
Oh, heck, I paid $2.79 for gas just this morning. Anybody that thinks that we won't hit or beat $3 is huffing low-test fumes. Prices have increased an average of about 2.75% per week for the past 10 weeks. At that rate of increase, gas will breach the Energy Information Agency's suggested $2.63 cap by, easily by next week.
At that rate, it sounds like we'll be definitely paying $3 a gallon, correct?
Oh, yes, certainly. As for $3, we could see that within 4 to 6 weeks. And by midsummer, how does $4.50 a gallon sound, folks?
Of course, gas prices are connected to oil. After 15 British Navy personnel were seized at gunpoint by Iranian forces in the Gulf, oil prices rose to their highest level this year. Then there were the gunmen who kidnapped 3 foreigners in southern Nigeria, Africa's biggest oil producer. The incidents caused an immediate reaction in the markets, with a barrel of light sweet crude rising to $62.65 a barrel, its highest mark since December. Adam, do you believe oil prices will rise higher?
Demand and supply are in lockstep right now. They're very closely matched. Any interruption or even a head fake, an intimation of an interruption, will spike prices. This is directly tied to the demand curve, and demand is hard structured right now. We can't change that anytime fast. We may wish to reduce how much gas we're using, how much oil we're using, but they're societally locked in by where we live, what we drive, and what our needs are. On the other hand, it's very easy to change the supply side of the equation, or even indicate that someone may try and change the supply side. One disaster in Houston, one storm in the Gulf, one incident in the Straits of Hormuz, and all of a sudden we're going to see both oil going up and a direct impact with the economy at large.
Let's go back to gas prices. The Energy Information Administration reported refineries operated at 86.3% capacity last week, up 0.7% for the prior week. Meanwhile, gasoline inventories dropped by 3.4 million barrels last week to 210.5 million barrels. With decreased gasoline inventories in an upcoming driving season, that being the spring and summer months, is it possible the inventories won't get up with supply?
Oh, absolutely. I think that we're already behind the curve now, and that won't improve. There have been some problems at the Houston shipping channel, which has interrupted the flow of crude oil to the refineries. This is affecting how much gas they can make. And that number, by the way, is a bit of a fictional number. I don't believe that we have ever seen us actually operate at 100% of capacity. So in reality, one has to keep in mind that genuine maximum capacity is closer to about 90%, which means we're within 4% of true capacity now. Gas inflation is here, and it's real, and it matters. It is really going to affect both how we drive and our pocketbooks. Gas inflation is real inflation.
So is there an opportunity for investors to turn this situation into dollars?
Oh, absolutely. Yes, yes. The first thing is you want to own oil companies right now. We've had a bit of a trough that's brought their prices down. That situation is ending very quickly, so you're going to want to be very specific. ExxonMobil, for instance, I don't know. Chevron, I like a lot. Valero looks a bit pricey. but I'd be inclined to wonder if they're ever going to stop at this point. That might be a buy.
Okay, if that's what we buy, what do we sell?
Oh, the thing to sell is the thing that's going to get hurt the most. When folks have to spend on electricity and they have to spend on gasoline, then the first thing that's going to get hurt is what they can curtail. In other words, discretionary spending and discretionary retail. This is stocks like Target, Walmart. I hate to say Target because they're a real favorite of mine, but I would not buy Target right now, and I would not own Walmart if you paid me.
Why are you suggesting we sell retail?
It's simple. Again, people have to make choices, and the first choice is going to be that second pair of blue jeans, that the extras, the things that don't really matter right now. Groceries, consumer spending may hold up, but discretionary spending is going to get penalized. Basically, the money the gas companies earn is going to come out of the pockets of consumers and therefore out of stores like Walmart and Target.
Thanks, Adam. Though I know what you say about higher gas prices makes perfect sense, I hope you're wrong. I'd hate to pay $4 for a gallon of gas. If that's the case, I'd better trade my car in for a hybrid. If you'd like to hear more about Adam, please feel free to sign up for his daily free e-letter, Market Report, or Dynamic Market Alert, which he contributes to regularly. I hope to see you again next week. Until then, I'm Krista Das. Have a great week.